Hi everyone, Natu here again, back with another video. And in this video, I'm going to explain how much do people really make for raising $10 million plus on behalf of their clients. Yeah, so there's a lot of talk in this industry about how much people raise money, or how people raise money for people, right? But when it comes to revenues, how does that really work? For example, if somebody helps somebody raise $10 million, exactly how much money are they going to make for doing that? Well, this is the beauty of the the quote unquote capital raising space here. So typically, how people will make their money is on the success fees, right? On behalf of raising that money. And along the way, it's really hard for people to compliantly do it sometimes, and the amounts of money that people make on behalf of a capital raise typically depends on the negotiation that happens and who's doing it. So the quick answer is, when it comes to high risk investments like equity, like preferred equity, you're talking about preferred equity, or rather preferred shares or common shares, especially preferred shares. The risk, it's harder to raise that type of money, that type of capital. And so the reward for doing that will be, generally speaking, it can be more. So if it's preferred equity or common equity, it's harder to raise, broadly speaking. So generally it can be more. When it comes to debts, broadly speaking, debts can be, more reasonable, and the rates are much lower. The success fees are much lower. So, depending on the risk of the investments, the type of capital it is, so not just the type of capital, equity or debt, but also the risk of it and how much effort it takes to raise that money, can have a contribution on how much people are paid from it, right? And so also looking at the deal size, there's a lot of talk of the Lehman formula, which is a formula that dictates, how people are paid success fees over time. But in practice, I barely see it. It's really just a negotiation. And the larger the deal, generally the lower the success fee, because it takes more people benefit from a larger success fee, and there's really no need to raise it too high in most cases. However, I've still seen success fees of 6% for 100 million plus transactions for investment banks. So that's it in terms of the success fees. But how do people actually make money off of those success fees? Well, it contributes not only to the type of investments and the negotiation, but also the power that the person has in the relationship. Because an investment bank, and I've seen this, like family office investment banks, typically the managing directors or the founding partners of the investment bank or the firm that helped them raise the money, the way that it will work, they would take probably the lion's share. And depending on how much work people did on the project, they'll take a percentage of it as well. And so it depends as well on how much people work to actually get the deal through the table, and how much money is raised in that sense too. So if you're the CEO and founder of the firm, then you make the most amount of money, obviously, because you have that much power to make. So it also depends on how much. So that's the positioning aspect. So we talked about the risk aspect and the positioning aspect, and it also depends on the compliance side of it, because it's illegal for people who aren't registered to proudly and boldly take success fees when investors put money, after they take money and wire it to the deal, because it shows that you're because if you're connected to that, then it shows that you are selling securities, or it's likely that somebody will come back to you and sue you for selling securities if you weren't registered to do so, or you weren't working for the right law firm or CPA or broker-dealer to do so. So that's why when it comes to consultants, a lot of people, they work with, and they have JVs with people on the buy side. So they'll have consultant relationships with the investment banks, so on the buy side, or with the money side, rather than the deal side. And then the side that's actually closer to the investor will already have those legal protocols in place to protect the consultants. And so that's how a lot of people who know how to navigate US regulations would do it. But when it comes to people just blindly taking success fees and then selling the deal, it's high risk to do that, because it shows that you're not properly registered, and then you're selling the deal on behalf of somebody else without being registered to do so. And so that's another complexity. And so with all those things, Yeah, it depends on, number one, the risk and the type of capital that's being put in, two, the difficulty of the deal and the risk of the deal itself, and how much effort is needed for the deal to actually go through. That can affect that success fee. Three is understanding the, when it comes to success fees, you have to also understand, where are you positioned? How much control do you have? Are you the CEO or the managing director or founding partner? Or are you like a side consultant? How much power and how much work did you put in to get the deal done? That contributes a lot to it as well. And four would be, how is it like on the compliance side? And depending on how it's like on the compliance side, you may be able to get it right away or in chunks. So with all those 5 reasons, those are some 5 pieces of the puzzle that, can show you how much would you make from a $10 million transaction. But if I were to talk about numbers, equity, I've seen 6%, could be as high as 8%, just broadly speaking. Debts, 2%, senior debt, 2%. And then junior debts, in other words, more high risk debts, could be 3%. But it really depends on all the things that we spoke about, because I've seen people take debt at 6% for 80 million plus transactions. And so it all really depends. But broadly speaking, difficulty positioning, control, and so on. And at the end of the day, that's why a lot of people in the financial services industry have very small firms. And the reason why is so that they don't have to split a lot of these fees with anyone, and then they get more revenue. So that's why these financial services industry firms, they don't really have that many people who are managing directors and partners anyway. And one more piece is, obviously, none of this obviously matters if you're not connected with somebody in a transaction. So if, for example, somebody goes direct, because people make agreements with people all the time saying that they'll give them the success fee, but people circumvent and they do all these things, right? So it doesn't guarantee anyone anything unless they really stand in between the transaction or their partnerships. That's why a lot of broker dealers always stand between the transactions and block people. That's the reason. It scares broker dealers to sleep. So that's why Raises.com, we take a different approach to it. Contact us if you want to learn more, but we take a unique approach to it as well. We take somewhat of a hybrid. Contact us if you want to learn more. But basically, if people are surviving off those fees at the end, what they do, they stand in between people and hide information from them so that there's no circumvention. Because if there is circumvention, that costs you millions of dollars. So, that's why Raises.com takes a hybrid approach, so that, through compliant relationships, we can benefit from all angles. Hence why we don't want to hide information from people. But with this, I thank you for watching this video, and hope that gives you a better understanding of how much money people make for 10 million plus dollar transactions getting closed. And I thank you for watching this video, and I'll see you in the next one.